Mr. Navin Agarwal, the CEO, Motilal Oswal MF. He will speak about the power of frameworks in investing. And to talk about Mr. Navin, he is the Managing Director and the Chief Executive Officer of Motilal Oswal AMC. Well, he's also co-authored, apart from the many other feats that he's accomplished, a book that's known as India's Money Monarchs, featuring interactions with India's leading investment managers. We would be happy if Navin could take charge, and we greet him with a good round of cheer as we are entering towards the final sessions. And of course, there is a nice break that will also come, after which it will be the time to win prizes. But right now, all eyes onto the screens there. Warm welcome to you.
Hi, good afternoon, MFD friends, and Cafemutual for having Motilal Oswal Asset Management on this very prestigious event. It's truly an honor to be here. And as you know, Motilal Oswal Asset Management and Mr. Navin Agarwal, who's our co-founder, has brought many refreshing investment ideas to the world. Today, in the interest of time, I'm going to first run you through the presentation, and depending on the time available, maybe I'll share a few stories as well. But basically, if you have them, you win means investment frameworks. When you have them, you win. All of you may have heard about buy a good business, run by a good manager at a reasonable valuation, and you'll make money. I think that's 101 of investing. In our view, if you complement them with investment frameworks, then it could make a hell of a lot of difference. Now, all of these frameworks, 25 frameworks that Mr. Navin Agarwal has authored from 1995 to 2020, are all available in a book called the QGLP checklist, which is available on Amazon and Flipkart. But I'm going to draw a few of those interesting frameworks for you, so that if that whets your appetite, you can go and deep dive into the book itself. All right, so what is an investment framework? It's a very rough definition. This is not a dictionary definition of investment framework, because there is not one. It's basically a time-tested thought funnel which can distill many winning investment ideas. So basically, when I know a company, when I know the business, when I know its management, it may or may not produce a winning idea, right? But that is one idea, right? This is like learning to fish. If you have these investment frameworks, and I'm going to demonstrate that to you, you can produce multiple winning ideas over many, many years through a single framework. So why do we need investment frameworks? Basically, to enjoy competitive advantage in the market, there are three types of edges. Information used to be an edge once upon a time. If you basically read the balance sheet, that itself was an edge 30 years back. Analytical edges actually helped 20 years back. And then last 10 years, we've seen the advantage of behavioral edges. We believe that if you have, maybe not 25, you can choose your own 5, 10, 15, 20 frameworks. If you have those investment frameworks with you, then that will aid the process of wealth creation in our view. How do you get them? Basically, there could be many sources of them. One of our favorite sources of investment frameworks, and I'm going to refer to some of these books, is these superscripts. And they are not something that are published last 5, 10, 15, 20 years. They could be as old as 40 years, 60 years, and 80 years. And they're timeless truths which are even relevant today to make money in the stock markets. So basically, these are the studies. They are all available. The whole study, a summary of the study, a video of the study on our website called Motilal Oswal WCS.com. Feel free to take a deep dive into the website, and you'll find a lot of interesting stuff. But our inspiration, our guru really is Warren Buffett. And according to him, his framework is very simple. Is it a business that I understand? Does it have favorable long-term economics, trustworthy management, and a sensible price tag? So when you think of the Motilal Oswal Master Framework, you will see a lot of similarities or inspiration from this basic, simple framework which was authored in the 2007 annual letter of Berkshire Hathaway. So basically, if you think of a funnel, right, the first screen of the funnel is quality of business and quality of management, right? That's the starting point. I don't want to invest in a stock for the long term. I don't want to partner with someone who's not trustworthy, reliable, and competent. I don't want to be in a business which is very headwinded, which is very challenged. So quality of business and quality of management is right at the top of the funnel. But buying quality businesses can make you bank deposit returns also. They may give you 5% dividend yield year after year, but may not create wealth. So what creates wealth? It's basically earnings growth. So we are looking for growth, which is the second funnel, second part of the funnel, second filter of the funnel that we use. And then longevity. We believe in buy right, sit tight. We believe in buy and hold. So if you really want to let that idea play out for you year after year, then you need that quality of business, that quality of management, and that earnings growth to sustain over long durations of time. And finally, if you pay an unreasonable price, then you could buy Infosys in 2000 and sit on it till 2010, and the company will keep showing growth in earnings, but you will make no money. So what are these quality frameworks? Let me start with a few of them. So basically, I talked about quality of business and quality of management. Really, we need both. It's multiplicative, it's not additive. It's not good to have quality of business, but also good to and if you also have quality of management, that's great. If one of them is zero, I mean, if a crook is running a quality business or a smarty is running a horrible business, basically there's no chance of you creating wealth in the stock market. So you need really both of them. And so all of you may have heard of my competitive strategy. I mean, Michael Porter wrote this book back in 1980, 42 years ago, right? And he drew up this chart where he explained the 5 forces to analyze a business, to decipher a good business from a mediocre business, right? And then sometimes they say that a disciple can be better than the guru. And one of the disciples of Michael Porter, Joanne McGreta, recently wrote a book called Understanding Michael Porter, where he took it to the next level, where he explained that the vertical axis, which is the threat of new entrants and the threat of substitutes, determines how much wealth or value can be created in that sector. And then the horizontal axis, which is bargaining power of suppliers, bargaining power of buyers, and rivalry among competitors, will decide how that wealth is shared between various constituents. Right? So, I mean, a guru can teach you in 1980, and then you can have a 2000s book where you're still learning and building on the shoulders of those leaders or thought leaders. So, I mean, this is just a sample scoring of various businesses on the 5 forces model, and you can actually come to objective assignment of which is a great business, which is an average business, and which is a gruesome business. Okay, so here's a very, very interesting study, the 2008 wealth creation study. This was our 13th wealth creation study. Buffett, in his previous year, 2007 newsletter, basically wrote that there are 3 types of savings accounts. One which has a very high interest rate, and that interest rate is rising year after year. That's similar to a great company, which is a fountainhead of dividends. It can keep paying you dividends, and those dividends will rise year after year. For instance, Nestle, which makes Kit Kat and Maggie, has seen dividends rise for the last 30, 40, 50 years. Have they ever come to you asking for capital? Have they ever borrowed money? They need no capital, right? So that's an example of a great company. But we are looking for not just great companies, we're looking for good companies. So good companies are like a savings account which pays a high interest rate, but allows you to deposit more money at that interest rate. It may not be the highest interest rate. So we are looking for businesses which can redeploy capital. And that is what gives you G in QGLP. If you've got ability to redeploy capital, you've got ability to grow those earnings. So a Castrol is a great lubricant company. A Bajaj Auto is a great two-wheeler company. An Oracle is a great financial services software company. But can they deploy another 1,000 crores in their business? No. They may earn 100% return on capital employed, but they cannot redeploy a lot more. So we need a combination of great and good companies. And what we definitely don't need is the gruesome companies. What is gruesome company? They pay you a very low rate of interest, but suck in a lot of capital. Basically textile business. They'll give you suboptimal rate of return, but demand hundreds of crores of rupees in working capital and thousands of crores of rupees in modernizing your old machinery. And you're not getting anywhere in life. It's like a treadmill. You'll kill yourself, but not move an inch forward, right? This is another fantastic study that we did back in 2013. This is the 18th study. So in the long run, stocks will make you as much money as the companies representing those stocks make. If they make spectacular money, we call it uncommon profit, then there will be uncommon wealth creation. And the definition of that really is return on equity greater than cost of capital. So we explain two concepts in this. The endurance companies, so the Nifty 50 companies that you see, a lot of them are great enduring companies like Hindustan Unilever, etc., etc. And the other is emergence. And I'm going to give you an example so that you can understand this better. JB Chemicals must be an age-old company. But for the first time that it crossed 15% return on equity or 14 or 15% return on equity, and from there on saw rising return on equity, right? So from being below 14, 15%, it emerged to being a highly profitable company. And you see what kind of wealth that can be created when that happens. So this is another favorite author, great guy, Philip Fisher, right? He's God according to us. What he has given to us as a gift in terms of learnings, we still use and still can make money. By the way, this book, Path to Wealth Through Common Stocks, was written in which year? 1960. 62 years old. Super text. You can still read it and make a lot of money. But what did he say? What does he basically say? Management is 90% in all analysis. Even if you have a challenging business, but it's run by a spectacular guy. So let me give you an example. Was cement a great business in the 80s? Not at all. But then came a hero called Narottam Seksaria, started a company called Gujarat Ambuja Cement. It became 1000x for investors in a difficult business. So really, in the longer term, management is 90%. The longer you plan to stay invested, the more important is the management. All right, now coming to growth framework. So this was the eureka moment for Motilal Oswal, where we used to be a quality investor. We wanted to look for great companies, but we finally realized that having just high quality but low growth is actually a quality trap. And we used to be invested in a company called Bosch. We used to be invested in a company, some of the MNC pharma companies. They were growing at very low rates, but they had very high return on capital. Like those great, good, gruesome, mostly great category companies. If you see the overall wealth creation in them may not be much better than the index growth. They may not be meaningful outperformers. And that's where we really, this was like we always used to idolize Buffett, who would talk about quality and moats and all of that. But we realized that when you combine growth with quality, right, which is the true wealth creators, the true multi-baggers, the true outperformers, that is where you can create far greater wealth in the long term. Now, here's another book, great guy, Adrian Slosky, Value Migration. This is a framework that we've used and created so much wealth. I told you, if you know how to fish, you can catch fishes all your life. If you have investment frameworks that are as powerful as value migration, you can find multi-baggers all your life. Adrian wrote this book when? 1980, 42 years ago. And still relevant. Basically, he said value migrates from outmoded business design to a superior one. So value was migrating from Boston to Bengaluru. Started when? 1990. What's happening in 2022? 17% IT services growth, $178 billion, 5 million IT engineers working, no houses available in Bangalore, Chennai, houses are selling like hotcakes, they are demanding salaries, attrition rates are very high. India's face has changed. You know, when you export $200 billion, you import $175 billion or $150 billion of goods. When you do $178 billion of IT exports, what happens? What is your import? Zero, because software engineers here keep coming all the time because of our demographics. So this is just an example. And another example is PSU banks to private banks. When HDFC Bank was born, Kotak Bank was born, you got a runway of 100 lakh crore industry that they can chip in at the margin every year and create wealth. There are a lot of good, great examples like this. Another phenomenal study that we did, this was the year 2007, this was our 12th study. Basically, India got independence in 1947. India touched the first $1 trillion GDP in 2007. So it took us a good 60 years to achieve the first $1 trillion. And we wrote this study in that year when we touched the first $1 trillion to say that every $1 trillion will be added in a shorter period of time. And if that were to be true, then the basic spends, as you become richer, the amount that you spend on roti, kapda, makan will not go up too much. Food, but your discretionary consumption and your savings will grow disproportionately. And that is when we launched a fund called the Next $1 Trillion Opportunity, because we are so excited about the theme. It's 14 years old and has generated fantastic returns. But we believe that this concept, if you apply to investing, this framework, if you apply to investing, even today, we are at $3.5 trillion, as Nilesh mentioned in the earlier presentation. As we go to $6 trillion, This will continue, the discretionary spends non-linearity, the savings and investment non-linearity, and you will have potential 10x opportunities. Right? Another great study, 14 study in 2009. Basically, what did we do here? We married two of our earlier studies. Okay? So 2007 study was next $1 trillion opportunity. 2008, McKinsey wrote a report called Bird of Gold, talking about the excitement that Indian consumer sector offers, right? And they explained how that is a winner category. Winner categories are those which outgrow the GDP by 1.5x. And within that, if you can find a category winner, and a category winner has what characteristics? Entry barriers, great management. And if you can buy that at a reasonable price, that's a winning investment. Another wealth creation study in 2014. So by this time, we had discovered QGLP. Now you all know what is QGLP. Now we tried to apply that to different segments of the market. We spoke about large caps earlier through the value migration framework where I gave you the example of HDFC Bank. Then we applied it to small caps. So if you buy QGLP companies when they are really small, right, then you have a runway for 100x. If you buy a $100 billion company and it's a QGLP company, chances that it will become 100x is near zero. Right? There is no $10 trillion market cap company still. Then, in the year 2015, we went ahead and applied this to mid-caps. What are mid-caps? Rank 101 to 250. And we came up with these three criteria. I spoke about value migration to you, but if a company is a small, tiny company, which is an industry leader in that business, right, and has industry tailwinds, and has value migration, that mid-sized company could potentially outperform the markets massively, on an average by 10-15% per annum. So we basically used the same core QGLP, applied it to small caps in the 100x study, applied it to mid-sized companies to this, and this also became one of our products eventually because we are very excited about the prospects of this. Finally, coming to longevity framework, 10 years back, analysts drew up that Nestle's competitive advantage may last for 10 years, and then there'll be terminal value. After 10 years, they're still thinking the same. So basically, here the competitive advantages keep extending. Finally, another important framework, linear increase in the number of years you invest can drive an exponential increase in the wealth created. So basically, if you compounded your money at 15% and it became 4x in 10 years, how much will it become in 30 years? Not 12x, but 66x. So that's really the magic of compounding. All of us focus on R, which is the return, but really what is in your control is T, which is time. If you can provide time to your investments, and that is something that can do magic. So in Bible, they say that love can cover a multitude of sin. In stock markets, the price that you pay can cover a multitude of mistakes. Right? There's no substitute to love in life, and there's no substitute to paying the right price in stock markets or in investing. What are the price frameworks? So, the most popular framework is PE. We don't believe in that. We don't use that much, but we believe that payback ratio and PEG are important frameworks to use. I'm not going to go deep dive into them, but basically we have a study, 2018, the 23rd study, where we've presented to you what are the Lakshman Rekha beyond which, if you're paying valuations for a company, your probability of making money is very, very low. So basically, in summary, if you can build an armory of frameworks, you don't have to build 25 frameworks because you're not necessarily running an asset management company, right? But if you can build your own armory of frameworks, both analytical and behavior, then we believe that this is something that can allow you to create enormous wealth over a long period of time. At MOAMC, we believe that if you have this master framework QGLP and these sub-25 investment frameworks, right, those combined with your understanding of business, your reading of annual report can create enormous wealth over long periods of time. Thank you very much.